Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. Anthony and I have made our way down to Texas. We're officially kicking off our Texas site tour 2.0 tomorrow, but that hasn't stopped earnings week. We've got Asher Genoot on the channel. We're going to be slicing and dicing Q3 earnings, strategy, and outlook moving forward. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comments section below what you thought of Hashate's results and if you're currently holding shares. With that being said, let's get into today's interview. Okay guys, away we go. We've got the CEO of Hashrate, Asher Genoot, back on the channel. We're going to be talking Q3 earnings, strategy, and outlook. Very excited to get into today's interview. Asher, thank you so much for making the time.
Excited to always be on here, guys. Thanks for having me.
Yeah, it's great to see you again. Now, I wanted to kick off with kind of the standard earnings question, Q3 earnings highlights. But before we do, can you give us a quick rundown? ABTC, Hashrate, you're obviously closely involved with both of these companies. It's been a very transformative year for the organization. Can you just give us a bit of a lay of the land, kind of high-level overview here?
Sure. Hut 8, we've transitioned into a company that's long infrastructure and energy infrastructure. So if you believe that power is going to be more scarce, if you believe in data center capacity, digital infrastructure capacity, AI, that's where Hut 8 is. We actually took a lot of that Bitcoin mining exposure and we ended up forming a company with Eric and Donald Trump Jr. called American Bitcoin. That company is a Bitcoin accumulator. And so it's doing a bunch of different strategies to try to increase Bitcoin per share. It's not focused on trying to get to the most exahash. It's not focused on trying to get the most amount of Bitcoin on the balance sheet. It's just Bitcoin per share. Are you increasing a shareholder's ownership of Bitcoin through all of these strategies or not? Because I think that's the only metric that really matters. Everything else is more of a kind of vanity metric in my mind, and I say all the time. And so with that, American Bitcoin launched April 1st. We took that company public in September, and that company now has been operating and doing very, very well. And so in our financials this quarter, we showed kind of that transition of that story, right? And so it's been exciting because we beat every single kind of analyst estimate in terms of the street. From a revenue perspective, from a profit perspective, American Bitcoin is what started in April. We're in November today, a company that's less than a year old. And in this quarter, I mean, it did over $60 million of revenue at a 56% margin. And that includes not only just the cost of energy, but Hut 8 builds the infrastructure. And we charge an infrastructure fee to American Bitcoin. So that actually includes that fee. Because most companies, they build it and then it's a part of depreciation and amortization. Everyone kind of ignores that. But this is like a real cost that they're actually paying, and it kind of hits their cost that people look at. And so I think across all regards, the fundamentals have done really good. For American Bitcoin, Bitcoin per share has continued to increase since the day we started. We're starting to show these charts on our socials of Bitcoin per share growth and how we're growing those Satoshis per share. And then at Hut 8, we're extremely excited because we have a massive energy infrastructure platform. I think a lot of folks were like, hey, are you about to announce a deal? We had some deals announced last week. Super proud of all those guys. And we're working really hard. And I think there's a lot of demand in the market today, which is great.
Yeah. I mean, it's come a long way. I mean, I remember when you formed the merge with Hut 8, and there were some skeptics out there at that point, even about your background, about Michael's, you know, and Hut 8 at the time had been this sort of like, you know, sort of just waiting around to not really doing anything in terms of growth. A lot of frustrated shareholders. You said to the audience on one of those early podcasts, judge me in Q3, give me the 3 quarters to get this company off the ground where it needs to be. And we gave you a report on that Q3, and we gave you a very high scorecard there because you had achieved exactly what you said. Moving forward now, you know, another period now, and look at where we are now, and you know, in the terms of the company and where it's gone. You've proved all the naysayers wrong there. In terms of the results, great results again there. I mean, obviously, you can see now the focus of direction in terms of the power, the mining, the strategy, the HODL. I'm going to ask a question on Bitcoin mining as a whole here, because we do ask it to all the companies at the moment. A lot of the direction we're seeing is towards high performance compute. But can you sort of like give us your interpretation of what opportunities, if that direction is moving towards HPC, that it gives to Hut 8 as the overarching company?
Yeah, so when we think about kind of the value of an electron and the value of power, we think that will only increase. You have Bitcoin, which is a large consumer of that power. Now AI is a large consumer, and the value per megawatt is a lot higher, right? And so there's a lot of focus on monetizing electrons for that business model. I think there will continue to be other business models as well, but our focus is, I think we have one of the largest Bitcoin mining platforms in the world today. And instead of saying, hey, we're going to pivot out of this business, we said, you know what, we're going to structurally spin out a company so we can keep on being the leader in the world there. And then for the data center market, we look to be a leader in the world in that business as well. Everything we want to compete at, we want to compete at the highest scales. And then once we've done that and we feel comfortable about our position, then we can look at other opportunities. And so today, data centers is an area that we're spending a lot of time on. We're spending time on commercializing the sites we have, building the relations with the customers, and being able to show the market our ability to grow and scale with those customers.
That's great. Hey, now transitioning back to the Q3 results here, can you walk us through a couple of the highlights, whether operational or financial? Then I'll let our good friend Anthony, the accountant, dig into those numbers a bit.
Yeah, happy to do so. So revenue numbers obviously went up both year over year, quarter over quarter, and beat analyst estimates. Our costs actually and the gross margins actually did better as well. And so across the board, again, I'm looking at it from a quarter over quarter and year over year basis. Our SG&A and our costs went down, which is great quarter over quarter. And we had some transaction costs last quarter when we were spinning out American Bitcoin. And so that's another element. Net income obviously was very, very strong. I think people don't really expect net income from companies in our sector. And I think we've shown net income a couple times these last couple of quarters. And so the overall kind of story, and I think strategy to what you said, Anthony, when I took over, look, when I took over Hut 8, American US Bitcoin and Hut 8 had just merged together, right? No one knew who we were. We were pretty low key as operators because when we were private, we said, look, we don't need PR. Like, we don't have customers. We already have all the investors we need. Let's just focus on building a great business. And Hut 8, I think investors lost a lot of confidence because they couldn't execute and operate. And that's why they wanted to merge with us in the first place. But it took us about a year to come together as a company. And so patience started waning out. And when we merged together, obviously it was about 2 months, and then I ended up taking over the seat. And that was right after a short report. And so when I took over, the stock was at $6.77, right? February 7th. And I came in and I said, look, these companies have not been merged yet. There's a lot of cleanup that we have to do on the Hut 8 operations and business. And the market will get to understand who the US Bitcoin team was, and we'll go and we'll prove it out. And so I think we've done a lot of that in last year. And then this year was a year about growth. And this year is a year about seeing the financial results from all of the fruits of that labor that we put the foundation for. And I think this quarter was just yet another kind of example of we're growing past expectations, where we have really strong fundamentals. Obviously, the focus for a lot of folks is, are you signing a deal? Are you signing a deal, right? But I think at the end of the day, are we building a strong foundational and fundamental business? And as we add more opportunities onto that foundation, we'll only grow more and more and more so. And so I think that's really, really important. Our balance sheet is really strong. Our debt to equity ratios are really great. And so that's something I also think about as well. During times of goodness like right now, you want to think about your balance sheet. Because if we look back in 2021, everyone was going crazy, the market was great, et cetera. 2022, the market spun around. And we were in a position where we were able to acquire other assets. We were able to restructure. We had some debt that we had to restructure as well that we learned a lot from. And so I think right now it's being excited about all the opportunities of growth, but also making sure we're positioning ourselves for all kind of market dynamics that may or may not come.
Yeah, I mean, there are a good set of results, so it's nice to get an income there. Obviously, some of that is helped by the fact you have got one of the largest balances of Bitcoin in any of the public companies out there, and the benefit of the FASB rules do help that. Obviously, in times when the Bitcoin price drops, and we hope there's not too many of those in the future, it has a sort of like the reverse impact, obviously. You mentioned there about sort of G&A costs coming down. That's music to my ears as a chartered management accountant dealing in costs for the last 35 years. And also, obviously, the fact that you've not decided to take the same route as maybe some of the peer miners in growing that sort of stock compensation, like we've seen there. I mean, for a relatively, and I'm going to say it's still a relatively new industry. The oldest Bitcoin miners are around about the 8-year mark now, so it's not really a sort of like an old industry. But we're seeing from sort of like a number of companies now, this stock compensation, I think from a retail investor, it looks like, is it getting out of hand? I mean, I understand the principles about, you're driving to make sure that individual goals are with the company goals, and you want to reward people, you want to maintain, keep people like that. But do you see, this is being used as a sort of like a tool to sort of like, to overcompensate people in a short term, thinking that, this might not be here forever. So let's make the running where we can. And I've done comparisons with some of the big seven, but the big seven companies in the world, they're delivering net profits with all the, net in terms of cash and everything in quarter after quarter. And I'm not quite sure everyone in the industry that we're in at the moment is sort of delivering at that level at the moment. When they do, and the shareholders see that share price rise, great. Then I think there's more aligned to that. But what's your view on that at the moment?
Yeah, so I have a very kind of deep philosophy on this. I think how compensation is structured is really, really important, because you can have PSUs, you can have RSUs, but how do they actually when do you get the shares, right? So I'll do a quick education for everyone listening.
Okay.
So if you think about stock-based compensation, there's options, but as a public company right now, really it's RSUs and PSUs. And what are those? RSUs is restricted stock units, which is time-based usually. And you say, okay, if you work at a company for X period of time, you're going to get these shares. And the standard is a 3-year RSU package. And so what is that is if you get granted X dollar, you get X divided by 3. And every single year you get a third, a third, a third, right? And that's kind of the typical, whether you create value, whether you don't create value, as long as your ass is in the seat, you're getting that RSU package, right? And so that's kind of the first structure. Then you have PSUs, which are performance-based stock units. And those are based on metrics. And I think the nuances there are really important, which is what are the metrics? Do people agree that those are good metrics, right? And the second is how do those get granted? Usually how that works as well is if you hit the metric, then they grant you kind of a third, a third, a third, so you can kind of get those across the board. When we started, last year was our first kind of comp year. And originally I went to the board and I was like, look, I don't want these kind of like annual kind of structured packages. Like, give me big, lofty goals, right? Like, I'm a big believer. Like, I'm super proud of what Elon has accomplished at Tesla. Like, I'm a huge supporter of the whole $1 trillion package, because if you can go and drive value for shareholders, like, you should be able to create value. Otherwise, you'll have folks like him say, you know what? I'm just going to go start a new business. Like, why drive all the value here rather than go start something new, right? And so when we first started, I was like, look, the company's not in a good spot right now. Just give me big goals and let me go hit those. And that's what I want to be driven by. And at the time, the board was like, look, you just took over. We're not in a position to do that. Let's think about how to do something kind of middle and down the fairway. And so actually last year, and we talked about this, I said, we're not going to take, so me and Mike, we're not going to take any RSUs, no time-based. It's only going to be PSUs. And the goal at the time was we would increase the share price by 50% or 100%. And the way that we structured it is really important. Because of the volatility of our stock, we said, if we hit the goal in the first year, it doesn't count. It only counts if we hit it after the first year. And the reason was because like we have to come and prove that we're fixing this business. So if we have some price appreciation, did we actually fix that business and get sustainable growth? And so if we hit it in the first year, we should be able to hit it again. Otherwise, we shouldn't get anything. But not only that, once we hit the goal, we only get the stock at the end of the 3-year period. We get nothing in between. And so that was a mechanism to say we're performance-based. We don't get paid unless we drive value. And if we hit the goals, we actually are retention-based as well, where we don't get anything until the end of the period. So let's say we hit it in year 2. If the stock price goes down, what we receive at the end of the 3 years is way less valuable, right? And so there's an incentive to hold and continue to grow that value. And so I think the way to think about, like, when you look at some of the information out there. It's like, okay, we have this time base and we have this performance base. It's really important to understand, like, what is the performance? What is the retention of that performance? How does it come out? And does it drive and incentivize the proper and right behaviors? Because if you're just going to get paid to be there, that's not that interesting, right? And I think that's not that great from a shareholder perspective. If you're paid to deliver and you're paid to grow, I think that's really, really important. We live in a world today where it's really competitive to bring on great talent. And look, we had two guys that I literally trained from out of college, and XAI poached them. And now one of them leads power and one of them leads infrastructure engineering for XAI. And they're 24, 25 years old, got paid 8-figure packages, right? And I mean, that's the world we live in. But the reality is, think about the scale of these projects. We're talking about multi-billion, if not tens or hundreds of billions of dollars of infrastructure. And so if you can go and you can actually drive that value, we should be able to reward folks in order to drive that value. And I think tying compensation to driving value is critically important. I think it's worked unbelievably well for Tesla to date. I think it will continue to work well with their new package. And so that's where my philosophy is a little different, because it's, are you rewarding two people just for being there, or are you rewarding them for driving value to shareholders? And if they're driving the value to shareholders and they're getting a percentage of that value creation, then I think that that's fair and that's fine, right? And so, like, the conversations we've had a lot internally is, historically, my ownership in kind of the company has been good, but not huge, right? And I said, look, if I were to start a company, I can own 100% of that company plus dilution and so forth. I want this to be the company that I'm at for the next 1 to 2 decades, right? I just turned 31 a couple of days ago. I've got a lot of juice in the tank to keep on building and driving. And I've shared with our board, give us goals where we can be meaningful owners of this company, where all of our wealth can be in this company, and let us go and achieve and go hit those goals. And so that's kind of my philosophy there, where I do agree, historically, this industry has not been great fiduciaries of how they manage compensation. I think it's primarily around structure and incentives. And I think if that changes, people can make a lot of money if they drive a lot of value, but they should not if they don't drive a lot of value. And that's kind of my overall perspective on compensation.
I'm going to say that's probably one of the most transparent responses we've had on the subject, actually, because we do ask it regularly. It is a challenging topic, and you've highlighted the real benefits there. If the shareholders are benefiting, and those shareholders at Tesla will significantly benefit if he gets that pay package, because to get that pay package, the company has to be worth something like $8.5 trillion, and that's about 5 or 6 times more than it's worth at the moment. So for every penny wasted there, that's
the thing is, if you have, like, I'm very much in that mindset, right? Is if you have entrepreneurial, like, founders and people who are leading these companies, usually how kind of compensation works is you hire a compensation consultant. They come in, there's a list of names, and it's like, okay, these are the names within your revenue market cap range. This is what everyone else is making, and you can kind of make in the 25, 50, and 75 percentile, and then that's your comp. So you basically get that without having to actually drive the growth and the value. And, like, for myself as a leader, I'm like, okay, so do I spend the next 10 years and I'm just put into this box of whatever this consultant comes up with, and, like, that's what I can achieve? Like, that's not going to work for a guy like Elon, right? Because then it's like, why go and sacrifice my whole life? I mean, he works every single waking moment. Why go and create those sacrifices if there's not these goals you can grow and you can achieve? And I think similarly, I mean, I'm in the office till like midnight, 1 a.m. most days. We just got a place in New York. My fiance is like, hey, are you going to be home much this week? And I was like, I'll probably be in the office. Like, all right, I'm going to go hang out with some friends in New York. I'll see you there this weekend. And so, like, I think that's really important, because it's, you want to give people goals. It's similarly, let's just break it down. Imagine if you had a salesperson in a company. They're incentivized by commission when they close deals. If you told them, hey, I'm going to give you this fixed salary no matter what, you close 100 deals, you close 0 deals, this is what your comp is, I can promise you, you'll have less aggressive salespeople out there going and hustling and making it happen. And so I think that's where, like, everything, in my opinion, is all about how things are structured. Does it drive the right incentives or not? And going one layer deeper into how things are structured ultimately is a determination of, is this good or is this bad? That comes to compensation, that comes to how you raise capital, that comes to how you actually get some of these deals that are announced done. Like, all the devils are in the details. And I think that's, and only time, unless you're super deep in the weeds, only time will have those things come out into fruition.
Yeah, that's music to both of our ears. And my former job before YouTube, I was in compensation design for sales teams. So I can 100% attest to what you say there. Now, another unique kind of spin you guys have been entertained at Hut 8 is this development flywheel. So can you talk to us a little bit about this structure? It seems like you guys have really got this system in place now, kind of rinse and repeat, which is exactly what we want to see as Hut 8 scales. Can you walk us through what the idea is, how it works, and where you see this going down the road?
The idea behind the development flywheel is, in order to create a very valuable and meaningful company, we have to have the ability to originate new sites, develop those sites, commercialize, and operate. It is not about, can we just change over our Bitcoin mining sites to AI campuses, but the ability to have this pipeline of growth. And so from kind of day one, when we started the business, we started talking about, I think when everyone started talking about exahash, we were talking about megawatts. And we were like, what are you talking about? Why are you talking about megawatts? Talk about exahash, right? And we're like, no, this is the kind of the underlying thing we're really working on. And if you look at our sites today, in our development pipeline, we have about 1.5 gigs of new sites. We have a site in Louisiana, a site in Chicago, a bunch of sites in Texas. And none of those sites actually existed in our Bitcoin mining days. All of those are net new sites that we've developed and we've grown, and now we're commercializing. I think that's unique because the gigawatt that we have in addition to the 1.5 gigawatts, those are operating, whether it be power plants or Bitcoin mines, and we haven't changed or converted those. We just said, hey, that business will operate there. Let's go find net new growth and net new power. And so what we'd like shareholders to see and understand is the development flywheel that we reference is really important because a structural foundation for the growth of the company. Because if we just focus on these are the sites that we have, once you commercialize them, then what's next? Where do you grow from there as a company? And so that's where, like, yes, we've taken a little bit longer than others in announcing deals into the market. And obviously would have loved to announce deals earlier. And once we kind of announce, we'll talk through all the stories of the twists and turns and the delays and the customer almost signing, et cetera. We'll go through all that, and I'll come back on when we can do a deep dive on all that. But what I think is unique for people to understand is, wow, they saw the demand in the market. They have an extremely experienced power team, and they went and found new sites in a market that was extremely hyper competitive, and they were able to commercialize those new sites. Because if, like, us finding sites 4 years ago was obviously a lot easier because there wasn't demand. It was all Bitcoin mining folks that were competing for it. Today, you have the whole world competing against finding power and demand, and being able to continue to do so, I think, is really important for the growth of the company and the stable kind of year-over-year growth that we want to deliver.
I mean, in terms of those, the sites that you've already got ready and the ones in development, I mean, that takes you probably close to that 3 gigawatts. But in your presentation pack, you have this sort of aspiration, to grow, over 8 gigawatts. I mean, I've seen some large increases in some of the miners there with this portfolio of power, and it can be sort of like any number, but you've created this really big number. How sort of like confident of you getting towards that in the next few years? In a very commercial, competitive landscape, as you just highlighted.
We are a big believer of showing people how we're going to grow and giving that information. So we were the first, I think, to talk about megawatts.
Yeah.
We were the first to release a megawatt pipeline of sites that are not existing, and then more and more people joined on. What we're doing now is actually going even more granular. So if you think about this funnel and this flywheel, we start at the top, which is the most amount of megawatts, is what is called our capacity or megawatts under diligence, which are sites that our energy origination team is out there negotiating, diligencing, and figuring out if it works for us. Then we get into a category called megawatts or capacity under exclusivity. That's where we said, you know what, we like the site, we've done the initial diligence, we like the overall economics of the deal, let's get into exclusivity, you can't talk to anyone else now, and let's try to get a deal done, right? So those are an active discussion and negotiation to get a deal done. We released a new category recently called capacity under development. Those are sites where we've signed on the dotted line, we either own the power, we either own the power, the energy service agreement, the interconnect agreement, the land, the option to the land, et cetera. But we have site control and we have power control and access to. So now we're doing pre-construction work, land, civil, fiber, starting commercialization customers with conversations with customers. There's going to be a new category that we're going to come out with called capacity under construction, which is a site has been commercialized. We're no longer trying to figure out who's going to go there and what the economics are going to be. We've announced that to the market. And now we're just in construction phase until it starts generating revenue. And then we have the category, which is our capacity under management, which is the megawatts we're currently managing that generates revenue for us. And so what I expect for shareholders to do is look at all of those layers, look at the megawatts within each layer. You'll start seeing megawatts transfer, right? We had a lot go from exclusivity to development and drop in. And so the higher you go, people will give a bigger discount because the higher it is in the sales funnel, right? The lower you go, you'll give a higher value to because you're like, okay, well, if they've already started spending money locking in the land and the power, this seems a lot more real. And so I think that level of transparency, like what I believe our job is go build a great company, with our philosophy and our strategy and be super transparent about how we're doing it. And then we'll get the shareholders we deserve. The ones that will look at that information and say, this is super exciting, this is undervalued, great. If the shareholders say, hey, I don't like this, I like another company, then great. They should put their money in what they believe in. I think by being transparent, I think we're leading the market in how they should think about how they should disclose to folks. And I want us to continue to do that across the board. And I think that's really important. You guys have seen this. Like, I've been very close to the chest on talking about new data center deals. We essentially haven't, right? Louisiana got leaked. That's why that came out earlier in the year. And so if you look at the business today, like our value in our ownership of ABTC, the value in our Bitcoin, plus the value in the megawatts we have in our expansion capacity, I mean, I think we're probably one of the lowest traded megawatt per EV multiple out there. And I'm a believer that short-term stock price like is not going to matter because the real value will be appreciated as more and more people appreciate the story. And we saw that when we were at $6.77. We're about 40 to 50 now, and we'll see the same thing when we're much higher.
Yeah. Sorry, go on.
I was just going to say that's a great breakdown of that pipeline. And we specifically wanted to double click on some of that future expansion. We've heard from other management teams, Patrick Fleury specifically, that the Texas backlog is fairly significant. You and I were chatting about the SB6 impact on that prior to starting recording here. Can you talk to us a little bit? I know you have sites all over the states. You do have a large concentration in Texas. How does this SB6 impact future capacity coming online?
So basically in Texas, what's happened is you have all of these developers, from large scale developers who have real balance sheets like ourselves to smaller guys in a truck going and locking up land and filing for an interconnect. And so you have this huge queue of people that want power. And this is just not in Texas. This is across the whole US, right? And it's hard for the utilities to differentiate who's real and who's not, what projects are real and what are not. Because a lot of the folks that don't have the balance sheet, they apply, then they try to go and find someone to buy it from them. And they're like, well, I'm in the line. Look, come and buy it from them. And so they're putting in new rules to try to filter that out. That includes kind of more deposits up front, right, to show that you're serious. That includes going through a thoughtful and regulated process. So with kind of the SB6, there's new rules around these interconnects. Some of them have to go through the PUC for approval now, not just ERCOT and the local kind of transmission provider and operator and utility. And for some of the projects that haven't been energized yet, they want you to go through and redo some of those studies. And so that's where you might have changes in timelines and adjustments and so forth. I think from our perspective, this is healthy maturity in the market because you're getting rid of a lot of the noise and it allows folks who really have the ability to develop, who have the balance sheets to develop. It takes away a lot of that noise in the system and allows the energy companies to know who's real and who's not, who has the ability to actually follow through with these commitments, and who's going to kind of get this agreement on power and go and try to go find a buyer right on the back end. And so this is happening in Texas, but it's also happening across the whole US. What you'll see is deposits going up. So for people need to put real commitments down that they want to lock in the power. They're not going to be able to just say, hey, this is what I want. You're going to see there's going to be more requirements. And what does your load look like? How does it actually operate? How does it flow within the grid? And so what may happen is obviously some short-term pain with folks who have sites already because they have to go through this process. I think long-term for legitimate developers that have large balance sheet, it's actually healthier because it reduces the amount of non-real competition and allows you to have actually faster queues and a faster process to find and develop opportunities.
Now, you've mentioned the rumors about the Louisiana, which came out obviously in the local press there, and obviously that's passed now. But in terms of developing power now to direct towards HPC, sort of how confident are you, having seen the number of contracts we've recently seen signed in the Bitcoin mining space? How confident discussions that you're having now, seeing what types of strategies certain miners are using? Are you arranging deal? And what's your preferred preference in terms of co-location versus, say, a CSP contract, the one we've just seen highlighted last week with Iron and Microsoft?
So we've seen a lot of the deals that have been announced. We've been a part of those conversations. We've seen them. We've seen those structures. I think for us, like as I mentioned, similar to compensation, structure is really important because announcing a deal and saying this is the total contract value, et cetera, what are the nuances in that deal? Who is backstopping that deal? Are they backstopping the debt? Are they backstopping the equity? What is the mechanics of how everything works? I think that's really important to us because whatever decisions we make today, even if we get a stock price bump because people are excited, will that value continue to accrue for the next 5, 10, 15 years during the duration of these contracts, right? Plus any extension periods that exist. And so we've been very picky in finding the right deal and the right partners. And I think that I believe will pay out in the long run. And I think we've built credibility with folks when we said, hey, this is not the right deal for us. And people were like, what do you mean? Don't you need to announce a deal? I was like, we need to announce the right deal, right? And I think that's built credibility with some customers as well. When we think about colo versus GPUs, it's a different business model. Obviously, the markets today are loving GPU demand and capacity. Some of the folks like Aaron have done extremely well, and that's awesome. And so the question is, what risk reward are you taking? And that's what I always think about. And again, shareholders have the right to choose the risk reward that they want when they invest in companies. And it's understanding what that is. And so I'll go through that a little bit now. When you're developing a co-location data center, really at its core, you're a development and infrastructure company, right? And so when we sign a deal, you can either sign a triple net lease deal or a gross modified deal. And I'll go into what that means in a moment. A triple net lease deal is pretty simple. It's, I will build this for the customer at spec. There may be kind of some delay penalties if you don't get it on time. If you actually don't deliver, there may be termination depending on the contract, right? And so really understanding, because all these timelines are super aggressive as well. So what happens if there's delays and it doesn't? Are there delay penalties? Are there termination rights? What happens? And so those are important nuances. Then once you deliver and you actually build it on a triple net, you actually don't end up taking any more of the liability and responsibility. The customer comes in, they pay for taxes, operations, maintenance. Usually your responsibility is like making sure the building and the roof and the landscape is good. And outside of that, like you're essentially at 99% margin on those deals. And so from a triple net perspective, it's actually really good because you lock in 15 years of cash flow, and those cash flows come every single year. If there's some issue with the site, the customer has to address it. They have to fix it. They have to pay for it. And so that's really interesting. Then there's gross modified deals, which say, hey, you're delivering me this building. There's certain service level obligations, SLAs, that I want you to be in charge of. And if you don't meet those and I don't get the power, I don't get the fiber, et cetera, then you'll get a penalty for not meeting that. And so then in those deals, you are not making 99% margin because you have to go hire the people, you have to pay for the maintenance, sometimes property tax, depending on the structure. And so you're wearing all of that risk, right? And so usually it's plus or minus 80%. It's about 20% costs to do it. And you can't think about those as pure profit because you're putting out billions of dollars to build the data center, right? It's like back in mining. People are like, look at my profit for mining, but it's like, what about depreciation and amortization? You spend a lot of CapEx to actually go make that money. And so it's not pure just profit and margin. It's what is your return on that capital outlay? And that's really important to think about. And so for gross modified, you're taking a bit more risk. But if you're developing a well, you have the same kind of construction risk, which is, are you building it right? Are you delivering it on time, et cetera? But then for 15 years, you have service obligations that you have to deliver. And if not, if you get hit with penalties, it can be severe and you can wipe out a lot of those cash flows, right? And so I think, but on the colo side, there's really what you're underwriting is who is your customer and will they be able to pay for those bills for the duration of that contract? If you sign a deal with a hyperscaler, your question is, will that person be around, be solvent, and will they pay for this contract? You're taking a lot less risk on, is this AI demand going to exist for the next 15 years or not? Is there going to be ebb and flow? Because you're really revisiting that in 15 years if they don't extend and you're going to release. On compute, it's a bit of a different business model. On compute, usually the terms are somewhere between 3 to 5 years instead of 15 years.
Yeah.
And the analysis you need to make when you run that contract is, are you actually going to make a return on the CapEx you make? Or after your cost of capital, are you really betting on the residual value of the chip? And that's really the analysis that you're making. You get a faster payback because the chips depreciate much faster. I mean, we saw this in mining. Every 3 to 4 years, the old chips, like no one cares about, they're all onto the new chip and the next chip. That's why we built Vega. I have a belief you need to build cheaper data centers for old chips down the road. And so we're starting to kind of build some of that infrastructure because people are going to need to bring them somewhere. For mining, we sent them over to Africa and South America because that's where a lot of demand is. These chips, you can't just export wherever you want. And so that's kind of a thought process there. But so that's kind of the high level overlay. And then how we think about it at Hut 8 is this. Hut 8 is the energy infrastructure company. We're low risk. We focus on structured yield and returns, and we're essentially betting long on megawatts. And we want to lock in those contracts in those duration. But in terms of getting exposure to ASICs, which is the Bitcoin exposure, or exposure to GPUs, which is kind of the neo clouds, we have two other businesses that we own. American Bitcoin for ASIC purchases, Highrise for GPU purchases. And so those shareholders that invest in those individual businesses are okay with the risk of the short-term duration, higher return profile. That's what they want. And so that way we're able to drive our cost of capital down at Hut 8. Because if you think about it, when you build a data center, your payback is like 5-6 years unlevered, right? Obviously faster levered. When you look at your chips, your payback is 2 to 3 years.
Yeah.
But it's also the long-term value. A substation will last a lot longer than 3 to 5 years. And so that ties directly with the asset. A building is going to last a lot longer than 3 to 5 years. And so at Hut 8, you want to drive that cost of capital down because you have a lower IRR per year, but it's a longer asset. For chips, your cost of capital will be higher because the investor's saying, hey, you're targeting a higher return. We want more because we're taking that risk as well. And so how these deals, in our opinion, are structured, who are the pools of capital, that's why we've structured the business in the way that we have. There may be deals where we have a colo and then Highrise actually joins as a part of that deal and they find that the chips. We're having a lot of those active in live conversations right now. I tell people to think about Highrise as a call option. We launched that. It was a little late to the game because of the whole merger with Hut 8 delayed us about a year. We wanted to do it about a year earlier. The business today has about 1,100 chips, pretty small relatively to kind of larger scale neoclouds, but one or two of the right deals will catapult that business into limelight. And then also, I think what's important as you think about kind of these chips, I was actually talking to a very large consumer of this. And he's like, Asher, I want to kind of give you some thoughts and advice. A lot of people are talking about technology. We have a technology layer. We hired the former head of AI in the Israeli Defense Forces to be our CTO. We have this confidential compute layer. But ultimately, like 7 customers are 90% of the compute demand for GPUs. And those folks all have their own software stacks. They're not signing contracts to get other people's software stacks. The software stacks is for the long tail of like thousands of people that are much smaller. And so really for that 90% of the market share, it's ultimately a cost of capital game, which is, can I deliver these chips to you in a bare metals world? Because any additional value I create on the software stack, et cetera, those large folks already have their own vertically integrated software stacks. And so I think that's really important as well to think about what is true differentiation into what profile of customers as well.
That's great. Yeah, and I really like what you said about the residual value of the chips versus the infrastructure, because that's what we've been struggling with as well. It's very difficult to know what these chips are going to be worth on year 6, 7, 8. However, as you said, substation building construction, those are decade-long investments. Now, we've obviously seen the pictures out from Vega. I've got some phenomenal images, some video from the Twitter account here. I've also seen you tweeting a lot about Riverbend. This one's unique, obviously very aggressive build out strategy. It's also in a different power market, not in ERCOT, I believe in MISO. So can you talk to us a little bit about how this market versus PJM versus ERCOT compare? You said similar backlogs in all three. And then Riverbend itself, what's kind of the grand vision here?
When we developed the Riverbend campus, we actually took a very first principles approach. We said, where are people not looking for power? But where is underappreciated that could be a large data center market? This was before Meta announced a deal in Louisiana. This was before anything. We said, all right, Louisiana is interesting because it sits in between Dallas and Atlanta, which are two large data center markets. You have the fiber connectivity between those two, and Louisiana is right in the middle. Louisiana also is one of the largest producers of gas, right? And all of the kind of natural gas goes into the rest of the world to power all these power plants. So we're like, you have the power there, you have the fiber there. Why are people not looking? So then we said, where can we go and build a campus that can really scale? So we looked around all of Louisiana, and we found this piece of property that had all of these high-level transmission lines that ran through it. I mean, we have gigawatts of transmission lines that run through this property. And around the campus, we have almost 4 gigawatts of power generation within a couple of miles. And so we said, okay, this is it. Like, if you look at the map, the transmission lines literally all connect at our property. And so then we went and we started playing a land game. We started talking to different landowners, and it was hard because a lot of these families own these pieces of land in their families for generations and generations and generations. And for them to kind of sell that, that was a hard conversation. We had to spend a lot of time locally building these relationships, explaining what we're looking to do. But ultimately, we started putting these pieces of land together. We started talking to Entergy Louisiana, which we have a beautiful relationship with today. They've been great partners. And we said, we believe this is a place on your grid that can really build a large-scale mega data center project. We think this is something that would be great for the state. And then the local parish, we're really close with the parish president, Kenny, and the other stakeholders like the sheriff and the school district. And we said this could be game-changing for the local community as well. And as we dove deeper and deeper, we've gotten close to the state, LED, the Louisiana Economic Development Board. We've gone close to the governor's office. And so all around, I mean, you have such a friendly state. Everybody's so pro-business and pro-building this asset. And we have, I think, one of the most valuable sites that fall in between a lot of fiber connectivity to the rest of the U.S., a ton of transmission capacity to transfer the power to the site, and a lot of generation nearby as well. And so we're extremely excited by that campus. I think when we started the discussions with folks at the very beginning, people were like, oh, Louisiana, I don't know, et cetera. Today, everyone's interested and open at looking at it. We've had a couple of discussions where we've dove in deep, and for whatever reason, didn't end up getting to the finish line. So that's why the site has taken a little bit longer to announce to the world. There's some opportunities where people have given us a deal. We didn't like the structure of that deal. And we said, hey, we think there's a lot of value here. We're not going to just compromise on a deal we don't think is the best deal. And so thank you. This is not for us. And so I think today we're very confident in the value that we have there. We're very confident in the conversations we've had validating that value. And now it's delivering, announcing that to the market. And obviously, because of that increased confidence, you're seeing on my X that I'm posting a lot more around the development of that project, and I'm spending more money developing that underlying asset.
That's good to hear. I've just had a question in from some of the retail shareholders, and they're sort of like asking a question about two of your most recent employees. I think Trump Eric and Trump Donald. Are they sort of like putting their time and effort into the company as in their terms of reference? What have they been delivering for you in the last sort of 6 to 8 months?
Unbelievably great partners. Unbelievably great partners. When we started working together and we started getting to know each other, more importantly, honestly, I wasn't really sure what a partnership would look like. And there were a couple things. One is, what are their personalities, right? There's obviously the public personas, but how are they as actually partners in a business? Are they looking just to be a celebrity endorser where they come on and they slap their name on it and then they kind of don't participate in day-to-day business? These were all the fears going into this. And we had deep and long discussions. We spent a lot of time together getting to know each other. And look, what I can tell everyone is this. From a character and personality perspective, some of the hardest working, most humble, genuine people that you'll meet. Like truly, for folks who are part of the first family, the success that their family has had, you can expect some ego. You can expect some folks, some personality, but like none of that with these guys. I mean, truly great, genuine people. Like honestly, anyone that I've introduced them and have them met and spent time with have been shocked by how grounded they are as individuals. So I think that's number one. From a personal perspective, I couldn't speak more highly. And you guys know, like I'm a pretty transparent and blunt person. If I didn't feel that way, I wouldn't say that, right? So that's the first. The second is from a work ethic perspective. I mean, it's funny. People are always shocked when I say this, but Eric is pinging us daily on how many Bitcoin did we mine? What's our cost of Bitcoin? Like he's driving it. And then when we were getting Vega online, he's like, when are we buying the next batch? We got to get this Hashrate online. We're losing this amount of Bitcoin per day by not buying these machines. We're looking at other deals we're working on now. And so like very deeply involved in the business, truly a partner and an executional partner in the business. And he's deeply passionate about this as well, because I think it bridges his passion for real estate and his passion for crypto and Bitcoin in one company, right? And that's something that has been great. And so, look, they're very active folks within the company. They're great partners. And for what we've done, if we take a step back and look at American Bitcoin, there's a lot of volatility in the stock. I think that's natural because it's trying to find price discovery, right? We have a lot of early shareholders that are getting unlocked next month. And so we'll see if we have more volatility that comes with that. And they've all made a ton of money. But if we look at just the fundamentals of the business, because I think, as you guys know, my perspective is always, you can't control stock price, you can control the fundamentals, and that will eventually come to equilibrium. And so we launched the company April 1st. We were at about 10 exahash. That's what HODL contributed, right? We raised capital. We built out the facility. And if we think about April 1st to where we are today, we're in the beginning of November. I mean, that's what, almost 7 months? I mean, not that long of a period of time. We've gone to 25 exahash online. Our economics, I think, are stronger than most of our peers. For a company, think about it, a company that's like about 6 months old, this last quarter in these 3 months, we did over $60 million of revenue at a 56% gross profit margin. And that includes the cost of the infrastructure that's not in DNA because HODL is charging an infrastructure fee.
Yep.
We have over 4,000 Bitcoin on the balance sheet already, outside of HODL, brand new Bitcoin that we built in the last 6 months. We were one of the fastest companies from incorporation to go public. Literally, the folks at the NASDAQ in our go public bell ringing was like, I think this is going to break a record for fastest incorporation to NASDAQ listing that we've ever seen. And so, and the Bitcoin per share and Satoshis per share continue to grow and increase. So the fundamentals are all there. You're going to see price volatility. The share price went up a ton. I mean, when we merged with Griffin, I mean, when we started the conversation, they were at 15 cents a share, right? And so you've seen massive appreciation as is. And so as long as we continue to focus on those fundamentals and grow it, we're excited that we can build a great business there and continue to build a great business at HODL, which we've set the foundation for over the last 18 months or so.
That's awesome. Hey, one other question related to Hashrate. We've seen a number of your peers, as you mentioned, pivot away from Bitcoin mining to HPC AI. So either pausing or slowing their exahash growth. Meanwhile, we've seen global hash rate just absolutely exploding. Obviously, a lot of other countries coming online. This is a great question for you because you've got the Trump members as part of the team. How do you guys see hash rate in terms of national security if Bitcoin does become very well adopted in the United States? Obviously, controlling hash rate is integral to that blockchain security. Can you talk to us a little bit about that?
We believe that decentralization of that hash rate is really important, meaning that no country owns a majority of the network, right? And so what that means is the US can't lose its percentage share of the network either, and needs to continue to have that percentage share in the market. The US should not have 100% of the hash rate in the world. It should be decentralized in order to really keep the spirit of what Bitcoin is and an asset that everyone kind of has contribution to. But we are very big believers of continuing to build this infrastructure in North America. We're very big believers of the energy story, of the security story. And so that's definitely a part of the name of the company itself, the vision, the thought process. And we're very proud company that's building and being here in America as well.
Now, a question on HODL. You've just articulated there that American Bitcoin has got over 4,000 Bitcoin on the balance sheet. You've got over 10,000 on the balance sheet. Are you sort of like, how are those conversations in terms of treasury management? I mean, is it one conversation? And also, are you looking to try and use that money to deliver more yield, to the company rather than just let it sit on the balance sheet itself? Obviously, hopefully with the Bitcoin price, getting that type of growth. But are there anything else that you can do? Anything that you're seeing competitors do that think actually something we may want to look into, or are the risks against it maybe too high at this moment in time?
How HUD-8 and how American Bitcoin treat the Bitcoin is very different. And I think that I'll talk through that because I think that's pretty cool,
interesting.
Right? For American Bitcoin, our business is around increasing Bitcoin per share for investors.
Yep.
And so how much risk we take there is very, very low, and our tolerance is very low because ultimately we never want a scenario where people lose Bitcoin. At HUD-8, Bitcoin is more of a balance sheet asset, and we're using that Bitcoin to help grow the energy business. And so one is kind of just an active asset. One is the foundational core to the business itself.
Yeah.
And so I'll start with American Bitcoin. At American Bitcoin, we're not going to lend the Bitcoin out to people. Why? Because we saw what happened in 2022 with the blow up of FTX, with Celsius. I mean, I was a part of a lot of those bankruptcies, buying assets and being a part of it. Like, we will not take rehypothecation risk. Like, that is not good. Even if we were borrowing against coins, we have our coins segregated in a wallet. We're not letting people take. So that's really important, right? The second element is, like, people are talking about trading around their coins and so forth. I think we were the first ones to do that at HUD-8. I mean, we made over $30 million selling covered calls last year. We actually were very quiet about what we were doing there. And now more and more of the market is talking about it. When you sell a covered call, you're selling you're getting money up front for the value of that token. So you're saying, hey, if we're at 100,000, I'm going to sell to you at 150,000. At American Bitcoin, we don't want to sell that upside. Investors want that upside. And so we are not going to do things like that as well, right? If you can do kind of basis trades where you're basically kind of on par and you can make yield, et cetera, that could be interesting. But American Bitcoin is all about preservation of wealth and growth of that wealth in a way that preserves it. We don't want to take the risk that we lose Bitcoin. We never sold a Bitcoin at American Bitcoin, and we do not intend to sell a Bitcoin, right? Even in the mining business, our comment is, if we're raising money and buying Bitcoin, why not raise money and pay 50% of the cost of a Bitcoin to be able to mine it? And so holding that Bitcoin is really, really important for American Bitcoin, growing Bitcoin per share through the mining business, through the treasury business. And we have a couple other verticals we're working on that are coming out that will drive cash flows to increase Bitcoin and ultimately Bitcoin per share.
So every decision ABTC is looking at that Satoshi per share to make sure it's bringing that extra value for the retail shareholder
in a risk-adjusted way where investors don't feel like the company is taking undue risk, because that is a metric. Our metric is not what is the share price, it's what is the Bitcoin per share, and then what is the multiple that we receive on that with people's confidence in that. And so that's really important. At HUD-8, it's different now because of American Bitcoin. At HUD-8, we want to juice our returns on that balance sheet. That's why we've taken Bitcoin loans. We have low cost of capital there. We've run covered calls because we're like, okay, look, some of our covered calls are at like 180, 200,000 a coin. And we're like, all right, well, for the next 6 months or 12 months, it gets to that. You know what? We're happy. If we can sell at that price, we're able to pull in tens of millions of dollars up front. That's great. A lot of those have expired without being covered. I mean, none of them have been covered. And so they've all expired without being covered. And we just made that money essentially for free, right? By selling some of that optionality. And so at HUD-8, I think we're a lot more aggressive on how do we drive yield and return, because it's an active balance sheet, active strategy. And so that's a really big difference. And that's why this goes back to like my perspective on structure. Just because two companies own Bitcoin doesn't mean they're treated equally. Doesn't mean how they approach risk, how they manage risk is the same. And it shouldn't be, because it should be based on what they're trying to solve for. And so, like, my big message to folks who are trading and buying these companies is you have to spend more time diving deeper, doing more homework on, like, how are these things actually working? What is the structure of people holding Bitcoin, compensation, data center deal structures? Like, the devils are all in the details. And then you'll either grow in appreciation or lack of appreciation for some of how things are operated when you actually dive under the hood on a lot of things.
One thing you mentioned there, which was clear, you obviously got the right people in the organization. I go back to when the industry started, and Bitcoin mining was potentially a very straightforward industry. You know, you got your buildings, you got your machines, you plugged them in, and you're mining. Now, these companies, and your company that you just mentioned then, and talking about the types of employees you're bringing in there, you've got to bring in such a lot of experience in so many vast different areas. You know, you've got like energy, you've got financial instruments, all these various types there. I mean, how do you go about bringing the top quality employees into your organization to help you get those strategies delivered that you're talking about?
We started the company with an energy focus, so that we're lucky by. We've had kind of an energy team, which is why we continue to find these sites. We're growing in them. So that has been a part of our DNA for day one. When we think about building sites, we always took pride in we could build faster, cheaper than other people when we were talking about the Bitcoin mining space. For the data center space, you have to give people credibility as well. So you have to kind of build the way that they want. You hire your GCs and things like that. I actually am a big believer there's a ton of value creation and opportunity to drive pricing, increasing quality, and similar to what we did in that space later on in phase kind of 2, 3. I think we're going through a little bit of a different transition, I'd like to say. I think there's obviously net new talent that we're bringing on from a data center perspective, but honestly, a lot of the talent we've already had here has been amazing, and they've been driving this, not net new talent. And so I think the infrastructure, you're adding more redundancy to these data centers. At the end of the day, they're cooling, they're powering, they're putting fiber to the chip, right? I think for us, we're going through something a little bit differently at Hut 8. We're going through an evolution from startup to growth stage company. And so what do I mean by that? There are folks that were part of our journey that took us to where we are today, and there's a couple of different dynamics there. There's some folks that continue to crush and be great leaders in the company. There are other folks, you know what? They've made a good amount of money. Now, do they still want to grind with me every single day for 12, 15 hours a day? Or do they want to start a family? Have they kind of hit their economical goals with everything that we've achieved? And are they still in that same growth and driving and mindset, right? The third is, have the scale of our responsibilities as a company in those specific roles outgrown that person's ability to keep up, right? And then third is, do we continue to bring great new talent in to drive ideas and thoughts? When I think about myself as the CEO of this company and before for US Bitcoin Corp and leading that, every year I have to be a different and better leader. And it's better for the stage we're at, because what made me successful last year is not the same thing that will make me successful this year in leading this company. And every individual within the company needs to think the same way, because of the rapid rate of scale we're doing, growth. If you think about the amount of, when we started the company, we had one site in Niagara Falls, New York for 50 megawatts. Today, we're talking about thousands of megawatts of facilities, infrastructure across everywhere. And so the requirements of the company are growing and changing literally month over month, not even year over year, because we're growing so quickly. And so how we build that organization, how do we make sure that we're scaling, but still with that hungry, growth-driven mindset and not a bureaucratic kind of slow mindset? Like, that is really, really important. So we're going through the stage now of this next phase of growth of, all right, we went from zero to a company worth a couple $2 billion. How do we go from a company worth a couple $2 billion to a company worth tens of billions of dollars? And then the next phase after that is, how do you get to hundreds of billions of dollars? And there's a different type of organizational structure, framework, people that help drive those pieces. And so that's why we had brought on Sean Glennon last year, where Shannon, we were kind of transitioning out, and he was going to his next chapter. And I said, you know what? I'm going to go off the norm. I'm going to hire a banker here rather than a traditional CFO. And we interviewed a ton of people. And I was like, Sean has been in power, utilities, and renewables for over 13 years. He deeply understands the financing of these large infrastructure projects, the relationships within the industry, and he's been an incredible addition to the team alongside a ton of other people across the organization.
Awesome.
That's awesome. What an incredible interview. You're wise beyond your years, Asher. Happy belated here. You just mentioned 31st, but so much detail, so much context to the strategy. Anthony, I'll kick it back to you for the final question, then we can let Asher wrap up here.
It's not a question, it's just final thoughts. I mean, Asher mentioned his birthday at 31 a few years ago and a few weeks ago, and I'm thinking he's still the youngest CEO in the Bitcoin mining space. And obviously now we're looking more of a outside the Bitcoin mine, we're looking at the sort of like the power space, really, as you quite articulate there. But I'm grateful today. I mean, these questions, are not presented for you to view. I mean, and you've been very transparent. I think some of those questions, I've not seen a transparency from a CEO or a director of some of the teams there. Sometimes they tend to skirt around them, and rightly so. It's difficult, but you've sort of like put some real colour to a lot of the questions, and I think shareholders will appreciate that. I mean, I've always said in my sort of 5 or 6 years in the space, transparency is key. If you're not transparent, then speculation comes in, and that's the worst thing. Then, the retail market have been very, very fortunate to receive the amount of information that comes from these companies via social media, via the platforms, and we're one of those platforms that help to deliver that. But they have like a thirst for information. They're constantly thriving for the next piece of information. And I think today you've probably, certainly filled their appetite with the response to that you've given some of the, I would say some of the more challenging questions. They're not ideal topics to talk about, but we have to talk about the topics. We're not here to just say, what's your favorite color, Asher, or what sports do you like doing? We're asking questions about you as a CEO of the company, the chairman of ABTC as well. And it's been a real privilege to get those responses in that level of depth, because we don't always receive that. And we're hoping this is just other miners will see this sort of conversation and think, you know what, we can do the same as well there. So maybe leading from the front again, Asher, starting that new year in the right spot.
No, really appreciate it. Look, we're excited to be building a great business that we can be proud of for decades to come. And we want shareholders to see how we think about the world. And if they align with us, we want them a part of this journey with us. And if they don't, that's okay as well. And they can kind of keep track of the growth. And so I think the commitment I made when I first took over at the beginning of last year is we'll tell you where our problems are, we'll tell you where our focuses are, and we'll go and execute those. And you can track us based on that. And I think we continue to hold that mindset in the things that we do. And if we make mistakes, we'll learn from them and we'll grow from them. But if we are transparent in how we're doing things, we can really execute on that strategy. And so, look, we're grateful for the opportunity to build an amazing business, and we're in a market that is fast growing. And so we're just excited to build, and we have a great team of people who are super passionate and hardworking as well. And so I appreciate everyone who's listening, who's been spending the time to follow our story. And there's a lot more to come here. And so appreciate you guys being a part of our journey thus far.
Thank you.
Yeah, thank you so much, Asher. I completely concur with you, Anthony. Well said. I'll just say awesome interview. We can't wait for the next one, Asher. Thank you so much for your time. We're cheering you on from the sideline here. If you guys have any additional questions, feel free to throw them in the comments section. Hit the like button. Feel free to subscribe. We'll see you back here tomorrow.